In May 2002, in a windowless conference room in Clinton, Mississippi, a small team from WorldCom's internal audit department pulled a single entry from the company's general ledger. The entry recorded $500 million in computer expenses booked against a capital account. When the team asked the accounting staff to produce the supporting invoices, there were none. The number, testimony would later establish, had simply been written down to make the quarter work. That entry was not an anomaly. It was a specimen. What Cynthia Cooper's team had found was one instance of a mechanism that had, over roughly 7 quarters, converted billions of dollars of ordinary operating cost into recorded profit. The question this episode answers is not why WorldCom did it. The question is how a single accounting distinction, the line between an expense and an asset, became the largest instrument of financial misstatement in United States corporate history to that date. The mechanism is almost banal. That is precisely what makes it worth understanding. The device at the center of the WorldCom fraud is called capitalization. It is not exotic. It is one of the most routine judgments in accrual accounting, made thousands of times a day inside every large enterprise. To understand the fraud, you must first understand the legitimate rule it inverted. Accrual accounting rests on a principle: cost should be matched to the period that benefits from it. When a company spends money, the accountant asks a question. Does this expenditure produce a benefit that is consumed now in this period? Or does it produce a benefit that will be consumed over many future periods? The answer determines the treatment. If the benefit is consumed now, the cost is an expense. It hits the income statement immediately and reduces reported profit for the current period in full. If the benefit extends into the future, the cost is a capital expenditure. It becomes an asset on the balance sheet, and its cost is spread across the future periods that benefit through depreciation or amortization. Consider the concrete case. A company that buys a fleet of delivery trucks does not deduct the entire purchase price against a single quarter's earnings. The trucks will be driven for years. So the trucks are capitalized as assets, and their cost is depreciated across their useful life, perhaps 5 or 10 years. A small fraction of the cost hits the income statement each period. By contrast, the fuel those trucks burn is an expense. It is consumed the moment it is burned. It produces no future benefit. It is deducted in full, immediately. This is the entire distinction. Capital expenditure builds an asset and defers cost into the future. Operating expense consumes and recognizes cost now. The rule exists to produce a faithful picture of periodic performance. It is not a loophole. It is the load-bearing structure of the income statement. Now consider what happens when that distinction is deliberately misapplied. Suppose a company takes a cost that is genuinely an operating expense, consumed entirely in the current period, and records it instead as a capital asset. Two things happen simultaneously, and this is the core of the mechanism. First, the cost is removed from the current period's income statement. Reported expenses fall, reported profit rises by exactly the amount reclassified. Second, the cost reappears on the balance sheet as an asset, where it will be slowly depreciated over years, meaning only a small sliver of it will burden any single future period. The structural elegance from the perspective of someone manufacturing earnings is total. $1 of operating expense that would have reduced profit by a full dollar this quarter instead reduces profit by only a few cents this quarter, spread thin across future years. The company has not reduced its actual cash outlays by a single dollar. The money was still spent. but the accounting picture of profitability has been transformed. At WorldCom, the specific cost subjected to this treatment was called line cost. Line costs were the fees WorldCom paid to other telecommunications carriers for the right to route calls across their networks. If a WorldCom customer placed a call that travelled part of its journey over another company's lines, WorldCom paid that company for access. These were WorldCom's single largest category of expense. According to the SEC's complaint, line costs represented roughly half of the company's total expenses, and they were, by their nature, unambiguously operating expenses. They were consumed in the period the calls were carried. They built no asset. They produced no future benefit. Under the matching principle, there was no defensible basis to treat them as anything but current period expense. The line cost. That is the mechanism. Now we turn to the architecture. How a routine accounting distinction was industrialized into a machine for manufacturing profit. To understand the architecture, you must first understand the pressure the architecture was built to relieve. In the late 1990s, WorldCom had grown through acquisition into one of the largest telecommunications companies in the world. The growth story rested on a single reported metric that Wall Street watched with unusual intensity: the ratio of line costs to revenue. This ratio, expressed as a percentage, was the market's proxy for the efficiency of WorldCom's core business. Analysts modelled it. The stock price moved on it. Management guidance was built around it, publicly, at a target in the low 40s as a percentage of revenue. Around the year 2000, the telecommunications industry entered a downturn. Capacity that had been built during the boom sat unused. Prices fell. Competition intensified. WorldCom's actual line costs, measured against its actual revenue, began to drift upward, away from the target the market had been promised. This is the structural condition that precedes most accounting fraud. A gap opens between the economic reality of the business and the number the market has been told to expect. The mechanism is the bridge built across that gap. According to the SEC's litigation release and subsequent enforcement filings, the response inside WorldCom's accounting organization proceeded in identifiable stages. Step 1, chronologically, involved reserves. Before the line cost capitalization began in earnest, WorldCom had accumulated a large stock of accrual reserves on its balance sheet. Accrual reserves are liabilities a company sets aside for anticipated future costs. They are legitimate when they reflect a real, estimable obligation. But an over-reserved balance sheet becomes what practitioners call a cookie jar. When earnings fall short in a given quarter, management can reach into the jar, release a portion of the reserve, and record that release as a reduction of expense. Reported profit rises. The SEC found that WorldCom released reserves against line cost to hold the reported ratio at target. This is the first phase, drawing down accumulated reserves to absorb the widening gap. Step 2 is the exhaustion of the jar. Reserve releases have a hard structural limit. You can only release reserves you have accrued. By the second half of 2001, according to the record, the available reserves that could plausibly be released against line costs had been substantially depleted. The cookie jar was running empty, but the gap between actual line costs and target line costs had not closed. If anything, the industry downturn had widened it. A new source of relief was required. Step 3 is the pivot to capitalization. This is the transition from the cookie jar to the line cost mechanism proper. Beginning in the first quarter of 2001, according to the SEC complaint, WorldCom's accounting staff began transferring line costs off the income statement and onto the balance sheet, recording them as capital expenditures under an internal category. The transferred amounts were booked to asset accounts, chiefly accounts characterized as construction in progress and related capital categories. The cost that should have reduced current earnings was instead parked as an asset, to be depreciated over a claimed useful life, measured in years. The scale of the transfers, as established by the enforcement record, escalated quarter by quarter. The SEC's filings document the reclassification of line costs in the following approximate sequence. In the first quarter of 2001, roughly $771 million. In the second quarter, roughly $560 million. In the third quarter, roughly $743 million. In the fourth quarter, roughly $941 million. The transfers continued into 2002, with roughly $818 million in the first quarter of that year. In aggregate, according to the SEC and the subsequent bankruptcy examiner's reporting, the improper capitalization of line costs accounted for the majority of a misstatement that ultimately grew to approximately $3.8 billion in the initial disclosure, and to a total figure across all forms of manipulation the company later restated of roughly $11 billion. Consider the structure of these entries as accounting artifacts. A legitimate capital expenditure begins with an economic event. An asset is acquired, an invoice is generated, a purchase order is matched, the asset is placed in service, and a useful life is assigned based on the asset's expected productivity. Each step generates documentation. The WorldCom entries had none of this. They were, in the language of the profession, topside journal entries. A topside entry is an adjustment made at the corporate consolidation level after the operating divisions have submitted their results, made directly to the general ledger by a small number of senior accounting personnel. It does not flow up from an underlying transaction, it is imposed from the top. This is the structural signature of the fraud, and it is why Cynthia Cooper's team found no invoices. There were no invoices because there was no transaction. The $500 million her team pulled did not correspond to any purchase, any asset, any economic event. It was a number entered directly into a capital account to achieve a predetermined result on the income statement. The entry existed to move the line cost ratio, and nothing else. Trace the mechanics of a single quarter to see the architecture whole. The operating divisions report their actual line costs for the period. Those costs, if left alone, would push the reported ratio above target and profit below guidance. At the consolidation level, a senior accountant makes a topside entry. Debit a capital asset account, credit line cost expense. The credit to expense reduces the reported line cost. The reported ratio falls back toward target. The debit to the asset account increases the balance sheet. Reported profit, freed of the expense, rises to meet the market's expectation. No cash has moved. No asset has been built. The only thing that has changed is the classification of a cost, and with it, the entire reported performance of the company for the quarter. Because the amounts were now sitting on the balance sheet as capital assets, they carried a small depreciation charge in subsequent periods. This created a structural feature worth naming. Each quarter's capitalization relieved the current period but planted a small recurring expense in every future period, as the fictitious asset depreciated. To keep the reported ratio at target, the volume of new capitalization in each quarter had to grow, both to bridge the current gap and to offset the accumulating depreciation from prior manipulations. This is why the quarterly transfer amounts escalated. The mechanism was not stable. It required ever larger doses to produce the same effect. A fraud built on capitalization is, by its arithmetic, a fraud that must expand or collapse. It cannot hold steady. You could, at this point, draw the diagram from memory. Operating divisions at the bottom, reporting real costs. A consolidation layer at the top, applying topside entries with no supporting documentation. A balance sheet swelling with fictitious assets. An income statement scrubbed of the expense those assets represented. And a single ratio at the center of it all, held in place by an accounting hand. The natural question is how this survived contact with the gatekeepers. WorldCom was a public company. It was audited by Arthur Andersen, then one of the largest accounting firms in the world. It was covered by equity analysts at every major bank. It filed quarterly with the SEC. Its debt was rated by the major agencies. The verification chain was fully staffed. To understand why it failed, we examine each link structurally, without assigning blame, because the failure is more instructive than any accusation. Begin with the external auditor. The bankruptcy examiner's report, prepared by former Attorney General Richard Thornburgh and his successors, examined the audit relationship in detail. The report found that Arthur Andersen's audit approach relied substantially on analytical review and on representations from management, and that the firm did not perform the detailed transactional testing that would have surfaced the topside entries. There is a structural reason this matters. An audit that tests transactions works upward from source documents. Pull an entry, find the invoice, confirm the asset. An audit built on analytical review works downward from expectations. Does this quarter's number look reasonable against last quarter's, against the industry, against the model? The line cost capitalization was specifically designed to make the top-level numbers look reasonable. The ratio was held at target. The trends were smooth. An audit that asks whether the numbers look right, rather than whether the entries are real, is an audit that a topside manipulation is engineered to defeat. The examiner's report also found that the accounting staff at WorldCom did not volunteer the capitalization scheme, and that access to the relevant general ledger detail was closely held. The topside entries were made by a small group. The operating divisions, which had the transactional detail, did not make the entries and were in the records account, sometimes unaware of them. This produced an information structure in which no single reviewer had both the anomalous entry and the knowledge that it lacked support. The entry lived at the top. The documentation, or its absence, lived at the bottom. The audit did not bridge the two. Turn to the equity analysts. The analyst community's central function is to model the business and price the security. But analysts model from reported figures. The line cost ratio that analysts tracked so closely was the very number the fraud was manufacturing. An analyst working from the reported financials would see a company holding its key efficiency metric at target through an industry downturn. That is not, on its face, evidence of fraud. It is, on its face, evidence of a well-managed company. The manipulation produced the exact appearance of operational strength that the analysts were built to reward. The verification the analysts performed was verification against the reported numbers, and the reported numbers were the artifact. There is a further structural point about the analyst layer. Some analysts covering WorldCom were employed by banks that also provided investment banking services to the company. The subsequent regulatory settlements across the industry, including the Global Analyst Settlement of 2003, established a pattern in which research and banking functions were not adequately separated. This is not specific to WorldCom, but it describes the structural weakness of the analyst as a gatekeeper. The analyst is not an auditor, does not test entries, and operates within an institution whose other divisions may have interests in the covered company. The analyst layer could not detect the fraud because detection was not its function, and independent transactional access was not within its reach. Consider the rating agencies. The agencies rated WorldCom's substantial debt. Their assessment, like the analysts', was built on reported financials and on the reported line cost ratio that suggested operational stability. A rating is a judgment about the probability of default, and that judgment leaned on the same manufactured numbers. The agencies were not positioned to test the general ledger. They consumed the output of the audited statements. When the audit did not catch the topside entries, the ratings inherited the error. Now stand back and ask the structural question that defines this section. What would have had to be true for detection to occur earlier? The answer is specific. Someone with authority to demand documentation would have had to pull a capital entry and ask for the invoice behind it. That is exactly what eventually happened, and it happened not through any external gatekeeper, but through internal audit. The reason is structural. Every external gatekeeper worked in one way or another from the top-level reported figures. The fraud was a top-level manipulation. Only a review that went beneath the reported figures to the underlying entries could find it, and only internal audit, with direct access to the general ledger and the mandate to examine it, was positioned to go there. The verification chain failed because every link in it, except one, verified the output of the fraud rather than its inputs. The unravelling began, as the record establishes, inside the company. In the spring of 2002, WorldCom's internal audit department, led by Vice President of Internal Audit Cynthia Cooper, was conducting reviews of capital expenditures. Internal audit's ordinary remit had been operational auditing. Financial reporting was the province of the external auditor. But Cooper's team, examining capital accounts, began encountering entries they could not tie to any underlying transaction. The sequence, as reconstructed in Cooper's later testimony and in the examiner's report, proceeded through direct inquiry. The team identified large amounts booked to capital accounts under the prepaid capacity and construction in progress categories. They sought the supporting documentation. The accounting staff could not produce it. The entries were the top-side journal entries described earlier. Adjustments made at consolidation with no transactional basis. The $500 million entry that opens this episode was one such item, a figure entered against a capital account with nothing behind it. Recognizing the significance, Cooper's team continued its work with unusual discretion, according to the record, working in the evenings and expanding the review to trace the pattern across quarters. As the team assembled the picture, the aggregate amount of unsupported capitalization grew into the billions. The team quantified the line cost transfers quarter by quarter, arriving at figures consistent with those the SEC would later document. In June 2002, the internal audit findings were escalated to the company's audit committee. The audit committee questioned senior accounting personnel. The controller, according to the record, confirmed the treatment. On June 25, 2002, WorldCom publicly announced that it would restate its financial statements, disclosing that it had improperly capitalized approximately $3.8 billion in line costs across the prior 5 quarters. The announcement stated that these amounts should have been recorded as expenses, and that, correctly stated, the company would have reported a loss rather than a profit for the affected periods. The SEC acted immediately. On June 26, 2002, one day after the announcement, the Commission filed a civil enforcement action charging the company with fraud. The complaint alleged that WorldCom had disguised its true operating performance by improperly capitalizing line costs and by other means, causing the company to report materially false financial results. The court entered an injunction. The Commission's action and the criminal investigation that followed established the mechanism in the terms this episode has described. The reclassification of operating expense as capital asset, executed through topside entries without supporting documentation. The collapse of the reported financials triggered the collapse of the company. Once the restatement was announced, the manufactured line cost ratio evaporated, and with it the appearance of operational stability on which the company's credit and equity had been priced. On July 21, 2002, less than a month after the disclosure, WorldCom filed for bankruptcy protection. The filing was, at the time, the largest corporate bankruptcy in United States history, with assets reported at approximately $107 billion. Observe the structural logic of the unraveling, because it mirrors the structural logic of the fraud. The mechanism required ever larger capitalization each quarter to offset accumulating depreciation and to bridge a widening gap. It was an expanding structure by arithmetic necessity. Expanding structures leave expanding evidence. By the first quarter of 2002, the amounts being moved were large enough and concentrated enough in unsupported capital entries that a routine internal review of capital expenditures could not avoid encountering them. The very feature that made the fraud effective in the short term, the direct topside entry with no transactional friction, was the feature that made it indefensible the moment anyone demanded documentation. There was no invoice to forge, no counterparty to enlist, no complex structure to explain. There was only an entry and its absence of support. When the question was finally asked, there was no answer. The subsequent enforcement record resolved the matter through the completed legal process. The SEC's civil action was settled, with the company consenting to permanent injunctive relief and a substantial civil penalty. In the criminal proceedings, the record shows that the chief executive was convicted at trial in 2005 on counts including securities fraud, conspiracy, and false filings, and sentenced to 25 years. The controller and other accounting personnel pleaded guilty and cooperated. These are matters of completed judgment and closed enforcement, not open allegation. We close as a forensic review closes, with findings rather than a verdict on human nature. The first finding concerns the mechanism itself. The WorldCom fraud required no financial engineering, no offshore vehicle, no derivative, no complex counterparty structure. It required only the deliberate misapplication of the most elementary distinction in accrual accounting: the line between an expense consumed now and an asset that benefits the future. That this distinction, made correctly 10,000 times a day in every enterprise, could, when inverted, produce the largest financial misstatement of its era, is the central structural observation. The tools of ordinary accounting are sufficient to manufacture extraordinary fraud. The sophistication of a fraud is not a measure of the sophistication of its mechanism. The second finding concerns the detection chain. The fraud survived not because it was cleverly hidden, but because it was hidden at the level every external gatekeeper trusted and none tested. The auditor, the analyst, and the rating agency all worked from the reported figures, and the reported figures were the product. Only a review that went beneath the output to the underlying entries could find it, and in the WorldCom case, that review came from inside the company, from an internal audit function operating outside its ordinary remit. The structural lesson for verification is precise. A manipulation executed at the point of consolidation can be detected only by verification that reaches the transactional detail, and any control chain that verifies only the consolidated output is defeated by construction. The third finding concerns what changed. The WorldCom collapse, arriving months after the collapse of Enron, was a direct catalyst for the Sarbanes-Oxley Act of 2002. Section 302 required senior executives to certify personally the accuracy of financial statements, attaching personal accountability to the reported figures. Section 404 required management to assess and the external auditor to attest to the effectiveness of internal control over financial reporting, directing verification specifically toward the entry-level controls that the top-side journal entry had exploited. The Act also created the Public Company Accounting Oversight Board to regulate the audit profession, ending the profession's self-regulation. These are the documented regulatory consequences. The mechanism was the capitalization of operating expense. The instrument was the top-side journal entry with no support beneath it. The structure expanded because its own arithmetic required it to expand, and it collapsed the moment a single reviewer asked for the invoice that was never there. That is the finding. The record is closed.